Eleanor Marsh had done nothing wrong. She'd sold a piece of land she'd inherited from her mother, deposited the proceeds into her savings account in 3 separate transactions over 2 weeks, and gone about her life. 4 months later, a letter arrived from the IRS requesting documentation to explain a pattern of deposits into her account. Not an audit notice, not an accusation, just a demand that she prove, with paperwork she hadn't thought to keep, exactly where every dollar of those deposits had come from. She hadn't structured anything. She hadn't hidden anything. She simply deposited money the way most people would, without knowing that the specific pattern she'd used, 3 deposits under a certain size within a short window, is exactly the kind of activity a bank's internal monitoring system is built to flag automatically, regardless of whether anything illegal actually occurred. This is happening to more retirees than most people realize, and almost none of them know the specific number that triggers it or the specific behavior that makes it worse. My name is Thomas Whitfield. For over 2 decades, I've worked directly with retirees and their families at the exact moment their finances collide with federal reporting systems, sitting across the table from compliance officers and tax professionals, watching people discover, always after the fact, that an entirely legal transaction had triggered a level of scrutiny they never anticipated. If this is useful to you, go ahead and subscribe, because every week I break down exactly what the system won't explain to you on its own. Here's what almost nobody is told, and it's the single most important thing in this video. This isn't about the IRS targeting seniors, and it isn't about doing anything wrong. It's about a reporting system built decades ago for a completely different purpose, one that now catches ordinary retirees doing ordinary things simply because the underlying rules were never updated to account for how normal people actually manage money later in life. Let me explain the actual number, because this is the part almost nobody has accurately explained to them. Under federal law, any bank is required to file what's called a Currency Transaction Report, or CTR, for any cash transaction exceeding $10,000 in a single day. This isn't a red flag or an accusation. It's a routine automatic filing that happens every single day for legitimate transactions all across the country. If you deposit $11,000 in cash from selling a car, the bank files this report, and in the overwhelming majority of cases, absolutely nothing further happens. This alone is not the problem. The actual problem, the one that caught Eleanor Marsh, is a completely different and far less understood mechanism called structuring. Structuring refers to deliberately breaking up transactions specifically to stay under that $10,000 reporting threshold in order to avoid triggering a currency transaction report. This is a federal crime, entirely separate from any tax issue, and here's the part that surprises almost everyone I explain this to. You do not need to intend to break the law for a bank's automated system to flag your activity as looking like structuring. The system watches for the pattern, not the intent. 3 deposits of $4,000 each within a 2-week period can trigger the exact same automated review as someone who deliberately structured transactions to evade reporting, even if you had no idea the threshold existed and were simply depositing money in the way that felt natural to you. This is precisely why Eleanor's situation happened. She wasn't hiding anything. She wasn't avoiding any threshold intentionally. She simply deposited proceeds from a land sale in a pattern that, to an automated monitoring system with no ability to understand context, looked identical to someone attempting to evade a reporting requirement. Banks are required, under the Bank Secrecy Act, to file what's called a Suspicious Activity Report, or SAR, whenever their internal systems flag a pattern like this, regardless of whether bank staff personally believe anything improper occurred. The bank employee you're speaking with at the counter frequently has no discretion in this at all. The flagging happens through automated software that monitors deposit patterns across all customers continuously, and once a pattern is flagged, a report is generated and sent to federal authorities without the customer ever being notified that it happened. Eleanor had no idea a report had been filed about her account until months later, when a separate IRS inquiry referenced the pattern directly. I want to walk through several other situations I see trigger this same kind of scrutiny, because Eleanor's land sale is only one version of a problem that shows up constantly with retirees specifically. The first is exactly what happened to Eleanor. Selling a significant asset, whether it's land, a vehicle, jewelry, or a business interest, and depositing the proceeds across multiple transactions simply out of habit or convenience without any intention of avoiding a reporting threshold. The second is receiving a large inheritance and depositing it in installments, sometimes because a family member advised doing so, believing incorrectly that smaller deposits somehow attract less scrutiny. This advice is not only wrong, it's precisely backwards. Multiple deposits under the reporting threshold, occurring close together, are considerably more likely to trigger a structuring review than one single deposit over the threshold, which simply generates a routine currency transaction report and typically ends there. The third involves retirees who withdraw and redeposit cash repeatedly, often out of a generation-specific comfort with handling physical cash, rather than relying entirely on checks or electronic transfers. I worked with a retired small business owner who had spent decades depositing daily cash receipts in amounts just under $10,000, a habit formed entirely from how his business had operated for 30 years, with zero intention of evading anything. That exact pattern continued into retirement as he wound down remaining business assets, triggered a federal review that took the better part of a year to resolve, despite there being no actual wrongdoing at any point. The fourth involves gifting money to family members in cash, particularly around the annual gift tax exclusion amount. Some retirees withdraw cash specifically to gift to children or grandchildren, and if those withdrawals happen in a pattern close to the reporting threshold, repeated across several family members within a short window, this can also draw the same kind of automated attention, even though gifting money to family is entirely legal. Here's what happened after Eleanor received that letter. She called me immediately, understandably frightened, assuming she was somehow in serious legal trouble. What we found, once we reconstructed the full transaction history, was that she had absolutely nothing to hide. The land sale was fully documented, the deposits matched the sale proceeds exactly, and there was no indication of any illegal activity whatsoever. But because she hadn't kept the original settlement paperwork readily accessible, and because months had passed since the transactions occurred, it took several weeks of gathering documentation from the title company, her attorney, and her own bank records to fully respond to the inquiry. The IRS ultimately closed the matter with no further action, but Eleanor spent nearly 2 months in genuine anxiety over a completely legal transaction, entirely because she hadn't known the specific behavior that triggers this kind of automated attention or the paperwork she should have kept in the first place. I'll add one more practical note, specifically for anyone managing money on behalf of an aging parent through a power of attorney. If you're making deposits or withdrawals on someone else's behalf, it's worth keeping especially thorough documentation, since a pattern of transactions managed by someone other than the account owner can sometimes draw additional scrutiny, simply because it deviates from that account's typical activity history. Clear records showing the purpose of each transaction can resolve this kind of inquiry considerably faster if it ever comes up. I also want to address a question that comes up constantly once people understand this mechanism. Does this apply only to cash or to checks and electronic transfers as well? The currency transaction report requirement specifically applies to cash transactions. Checks, wire transfers, and standard electronic deposits are not subject to the same $10,000 cash reporting trigger. However, banks maintain separate monitoring systems for unusual patterns across all transaction types, and a sudden, uncharacteristic pattern of large check deposits or wire transfers can still generate a suspicious activity report if it deviates significantly from your typical account activity, even without any cash involved at all. This is precisely why Eleanor's land sale, deposited partly through checks from the title company, still drew attention despite not being a purely cash transaction. There's also meaningful confusion around a separate but related form, the IRS Form 8300, which applies specifically to businesses receiving more than $10,000 in cash for goods or services, not to personal bank deposits. Retirees who sell a vehicle privately, for instance, sometimes confuse this business reporting requirement with their own personal deposit, when in fact, Form 8300 doesn't apply to the private sale of a personal vehicle between individuals at all. Understanding which specific reporting mechanism actually applies to your situation can save considerable confusion if a bank representative ever mentions a form by name. I also want to walk through a second case because it illustrates a slightly different version of this same underlying problem. A retired couple, the Doties, received a substantial legal settlement following a personal injury claim, paid out in a single lump sum by the insurance company. Rather than depositing the full settlement check at once, their adult son suggested depositing it in smaller amounts over several weeks, believing this would somehow reduce the amount of tax owed on the settlement, an idea that isn't accurate to begin with, since deposit size has no bearing on tax liability for a settlement that's often non-taxable in the first place. That well-intentioned but incorrect advice created exactly the kind of deposit pattern that triggered an automated review, adding months of unnecessary correspondence with the IRS to resolve a settlement that would have generated no tax consequence and no scrutiny at all if deposited as the single transaction it actually was. This case matters because it highlights something important. Much of the well-meaning advice retirees receive from family members about managing large deposits is based on outdated assumptions or simple misunderstanding of how these reporting mechanisms actually work. The safest approach, in nearly every situation I've encountered, is the most straightforward one. Deposit significant amounts as a single transaction. Keep clear documentation of where the money came from, and consult a tax professional directly if you're ever uncertain, rather than relying on informal advice about how to avoid scrutiny by breaking a deposit into pieces. Here is what actually prevents this entire situation, and it takes far less effort than people assume. Step 1. If you're depositing proceeds from selling any significant asset, land, a vehicle, a business interest, jewelry, or similar, deposit the full amount in a single transaction whenever practical, rather than breaking it into smaller amounts across multiple visits. A single large deposit generates, at most, a routine currency transaction report, which is far less likely to escalate than a pattern of smaller deposits. Step 2. Keep the original documentation for any significant transaction, the closing statement from a land or property sale, the bill of sale for a vehicle, the settlement paperwork from any inheritance, in a place you can access quickly for at least several years after the transaction. Eleanor's biggest challenge wasn't that she'd done anything wrong. It was that gathering proof took weeks longer than it should have. Step 3. If you're receiving a large inheritance, deposit it as a single transaction rather than spreading it across multiple deposits, and specifically ask your bank or attorney whether the funds should be accompanied by any particular documentation at the time of deposit. Step 4. If you regularly handle cash from a small business, even one you're winding down in retirement, talk to a tax professional specifically about how your deposit patterns are being monitored and whether consolidating deposits or documenting the source more thoroughly would reduce unnecessary scrutiny. Step 5. If you're gifting cash to family members, particularly multiple family members within a short period, keep simple written documentation of each gift, who received it, when, and how much, even though this isn't a formal legal requirement for gifts under the annual exclusion amount. This documentation becomes valuable if any pattern of withdrawals is ever questioned. Step 6. Never break up a deposit or withdrawal specifically to stay under the $10,000 threshold. This is the one behavior that transforms an ordinary transaction into something that can constitute a federal crime, regardless of your actual intent, if a pattern of intentional structuring can be established. Step 7. If you ever receive a letter referencing unusual account activity, respond promptly and directly, ideally with the help of a tax professional, rather than ignoring it or assuming it will resolve itself. These inquiries don't go away on their own, and delayed responses tend to extend the process considerably. Step 8. If you're uncertain whether an upcoming transaction, a sale, an inheritance, or a large gift might trigger this kind of review, it's worth a brief conversation with a tax professional beforehand, simply to understand the reporting mechanics and keep the right documentation from the start, rather than reconstructing it under pressure months later. I want to be clear about one thing before I close. None of this means the IRS is targeting you personally, and it doesn't mean you've done anything wrong simply by receiving a letter like Eleanor's. The overwhelming majority of these inquiries involve completely legal transactions handled by people who had no idea a specific deposit pattern would draw attention. The system isn't designed to punish ordinary financial behavior. It's designed to catch a much smaller number of genuinely illegal transactions, and it does so by casting a net wide enough that perfectly innocent retirees like Eleanor occasionally get caught in it. Right now, if you have a significant transaction coming up, selling property, receiving an inheritance, gifting money to family, the way you handle the deposit itself is exactly what determines whether it moves through your bank without a second glance or triggers months of unnecessary anxiety over paperwork you didn't know you needed to keep. The system isn't broken, and it isn't out to get you, but it also isn't going to explain any of this to you in advance. It simply watches for patterns, and it's up to you to understand which patterns matter before you're the one holding a letter you don't know how to answer. If you have a large transaction coming up, deposit it as a single transaction where practical, keep the paperwork, and don't hesitate to loop in a tax professional beforehand rather than after a letter arrives. If you found this useful, subscribe, because every week I break down exactly what the system won't explain to you until the day it's already too late to prepare for it.